Welcome to this walkthrough of the updated SaaS financial model from efinancialmodels.com. The purpose of this model is to prepare a financial plan for a new SaaS startup venture. SaaS means software as a service, and we want to use this model to determine the financial feasibility of our project. We want to obtain a better understanding of the relevant financial and project metrics. And also we want to use this model as a basis for our fundraising campaigns. In this walkthrough, I will explain how to work with this model, and depending on model version, we will develop a financial plan from 5 to 10 years. So let's jump right into it. In this model, we have different worksheets. You can see an overview of the worksheets on this tab here. We have one sheet for instructions, one sheet to explain the model structure, a sheet for the executive summary, breakdowns, then a sheet which goes through all the assumptions to develop the financial plan. Then we develop monthly forecast of all the metrics. We build our plan bottom up. We aggregate then the numbers in a yearly plan. We run break-even analysis depending on model version, then also customer lifetime value analysis, and we also have a sheet with other abbreviations. We now start with the assumptions sheet to prepare our financial plan. So we switch over to here. Then we have to estimate the number of subscriptions. For this, we will have to start first with estimating how many users we can get to sign up per year. As you can see, we are expecting user sign up from three sources of traffic. One is from organic traffic. Here we can simply enter the number of users we expect to attract in the first year, and then we can also see basically enter the growth rates we're expecting. And depending on what we enter input here, you can also see that this reflects then also in the later year as our user base is growing, and then also will impact and also subscriptions. So we start first with the user base, referrals and paid traffic I'll explain later on. If we get users, we need to also estimate how many of these users we can convert into paying subscribers. For this we have to enter a conversion rate. Depending on what conversion rate you enter, you see you will also affect, then you can influence the number of new subscriptions. So we now just have to work through all the blue cells. Blue means these are inputs, so we just focus first on the blue cells. Then we have here different plans. We have here a light, basic, pro, and premium plan for our subscription business. And you can see the pricing of these plans. That's where you would fill in the pricing. And what we also need to do is then to estimate in terms of the new subscriptions, what are they going to choose in terms of the plans. And we can enter here the percentages for how many are going to opt for the light plan, basic, pro, and premium plan. So we can allocate these number of new subscriptions to the respective plans, and then we will get basically the subscription numbers. Then another factor important is that all these subscriptions, they have specified durations. Normally we expect that this stays pretty constant. Here we can offer monthly, 3 months, 6 months, 1 year, 2 and 3 year plans. And all we have to do is to enter what's the percentage of new users who is going to purchase which type of plan. And because we are a SaaS business, we like long-term customers, so we are willing to give heavy discounts for long-term subscriptions. And what you can do is you can simply enter the respective discounts you're willing to give here. Then this will mean that your prices, you will start here with the monthly price, but then if you include these discounts, your pricing will go down. And on average, basically, we'll see that's the average price we we get depending on what percentage splits you enter here. This will in fact affect the average prices. So I'll put it back here and you see this, and this basically reacts. So we have now here the, we can calculate the subscriptions. We can also say how many of these subscriptions will be by what kind of durations, and we also can understand what packages, how many subscriptions are related to which packages. So we have entered number of subscriptions, the pricing, then we might also have additional sources of revenues. If we go to the monthly sheet, we have here all the parameters which I've just shown you. They will go and flow through all these sheets. You can track the calculations in this sheet if you want to understand this a bit closer. And then we also go to the monthly income statement, and as you can see, let me just scroll down. We have here various sources of revenues. We have here subscription revenues, affiliate income, advertisement income, and on this, in this section we can expect we could put forward what's the expected income we can generate from affiliate links or from ad we are placing on our website. However, these are just additional sources of revenue. If you don't want to use that, you can simply put these sources to 0 to exclude any effect on that front. So if you put this here to 0, these income sources will go away basically. Let me just do that so you can see that. If I put this to 0, voila, income sources go away, then this all shows 0. If you have any other income, you can directly enter the other income on this line here. If you need additional income streams, just insert another row and model your income stream somewhere above. The next task then is to also go through the cost assumptions. Here we can start with the direct costs. We foresee different types of direct costs that can be related to user per subscriber, and you can simply enter the expected annual costs per year, and then the model will allocate these costs to the monthly, the budget on a monthly basis. Let's go back here. So you can simply update these figures, and you can then see here what are the total direct costs, your budget results. What does this relate, or does this mean in terms of revenues? What's your cost margin, and then also what's your gross profit, the resulting gross profit margin after paying for these costs. So you can include your payment gateways fees. If you have hosting or API calls you have to pay, you can enter or estimate all the costs up here. The next section, the big cost block for SaaS company, we expect to be the employee costs. So this model allows you to put up the expected FTEs of people you want to hire. So you can basically build up the number of FTEs. You can enter these are grouped by categories. Then you can also input the salary levels by category, and also if you plan to pay any bonus in cash, then you can simply enter how many additional months of salary you want to pay because you need motivated employees to make your business happen. So maybe in case you want to adjust these costs, that you can do it easily here. Then another cost item are social insurance costs. So you can enter the percentage here, what you expect in terms of related social insurance costs. You will get the cost budget here, and we also will tell you what this is the expected percentage of revenues, what this cost block means. And on this graphic, you can see here this green one. That's pretty. That's one of major costs. Is all for developers. This would mean this would be a company where you plan to do a lot of automation so that you have to spend a lot of money improving your software to automate it more. And then you can use this graph to better understand a bit how your personal or salary costs are built up. Then we also have from above, if you remember, we had two sources of traffic, referrals and paid traffic. What we do here is that we analyze these costs a bit in more detail. These costs will not be included in direct costs. In this model, they're included in OPEX, and the way it works is that we estimate how many affiliate partners we can sign up, and then each affiliate partner will basically place links on their websites to our website, and we can estimate how many affiliate partners will disappear for whatever reasons. There's always some churn, and how much is the monthly referrals they can bring. As you can see here, we expect as the number of affiliates grows that we will first start with the most efficient one, with the top sites we can find or top partners, and then as we have to expand, on average we expect that we get less referrals. In case that would not be the case, you could also leave it constant, and then you see that you see if we put this at 5 here, then this graph would change. We can model the expected amount of traffic we can obtain. So I'll put it back here, and you can see we get the number of users and also the number of subscriptions from referrals. If we know the number of subscriptions, we can say how much we have to pay in terms of affiliate commissions. We enter the affiliate commission rate, and the model calculates us the respective costs we have to pay to our affiliate partners. For paid marketing, we enter a budget in our OPEX here, how much we want to spend. Once we have the budget, we just need to say about how efficient this is, what's the cost per click, how pricey these paid ads are, and what's then also the expected sign-up conversion. And then once we have entered that, it will tell us how many new users and how many new subscribers we can get. So, and this brings us already to the OPEX budget. So as a reminder, we have here the forecasted gross profit. We have here the most important cost block, which are the employees. That's calculated from above. And then we enter all our other OPEX budget items. And affiliates is already calculated. That's an output, that's not an input. All the rest is input. It gives you total OPEX. We can also say in those years, if you want to grow OPEX cost on an annual basis, you can just enter percentage and it will keep growing. Then here as a check, we will see the resulting EBITDA. And of course, our goal is to keep the number of years of losses as short as possible. So if you see the losses here are too high, simply go up, change the costs in the OPEX, or also find ways to reduce the costs here in the direct costs, or also in the employee costs. And this should allow you to obtain a bit better understanding realistically by when you can expect that this venture will produce positive earnings before interest, taxes, depreciation, and amortization. Then these are the annual costs. Then we also have capital expenditures and software development costs, where we want to activate them. For software development costs, we can either pay them and activate on the balance sheets, then we input it here, or alternatively we can also use one of these cost positions to enter software development cost, and we just expenses as we go. In this model, you see we have hired a lot of we're assuming a lot of developers, so that's why we do a lot of stuff in-house. But for all the purchased software. There is some budget here, and in this model we would activate that on the balance sheet. And this also means that the fixed assets, they go up from the capex. For instance, computers, laptops, etc. They would go in here. And the software, we expect that we can get a benefit, a long-term benefit, so that's why we would activate it here, and it will just be affected by, we will depreciate and then we'll add some new expenses. So that's the logic here. Then we need also to go through the general assumptions. You can enter here your currency code. So for instance, if your model is in euros, simply enter the currency code, and basically the model changes everything to euro instead of dollars. We go back to initial settings. We can also change the year of the timeline. So when you want to start your project in a different year, simply enter the year and the timeline will be plotted accordingly. Then also all the rest of the assumptions, days receivable, payable, etc., just update these assumptions. Selector, you don't need to update. This is just for one of the table settings to choose the options of the drop-down menu. You don't need to update. Maybe this one requires a bit of an explanation. So if you deactivate this, what happens is that this is about the payment collection. So this means in SaaS, we have many sales where we sell subscriptions for 3 months, 6 months, 1 year, etc. And we charge this upfront. So in case you want to just book it as revenue at the time of the sale, you put revenue recognition to no. And then it will basically, revenue will be booked at the time of sale. If you want to say no, I need this, my accountant tells me to do it otherwise, then what we do is we put this to yes, and this will happen now, this mechanism. So this means, let's say you are selling in the first month a 3-month subscription. We will then allocate these revenues to the 3 months, and we will only book 1/3 of the revenues for each month. And respectively, if you go to the 6 months, then we'll just divide it by 6 and so on. If we have further durations, we'll just split it by the number of months to do that. And the effect is that we have a bit a mismatch in terms of we collect payments upfront, but we only book the revenue over time. Here there's quite a bit of time lag because we have many subscriptions with 1, 2, or 3 years. So that's why this is there's quite a bit of gap. But it's also, I mean, this is free money. This is money which you already collect for the next month. You can use this to invest, and it's in your interest. So it's some things you want to understand and to be on top of. What we now have to do is to check if our business plan makes sense. We can do this either detailed by going through this monthly plan. We can use here these group items to, if you want to have a look into details, or if you want to just look at the aggregated figures. If you want to skip a bit, we can also directly jump to the yearly sheet. Here you have all the, and basically see if the overall picture of your business plan makes sense. You have here all the detailed income statement. You have a standardized income statement, so you can understand the cost structure, balance sheet, cash flow statement, also a view on direct cash flow, how much cash is coming in, how much cash is going out where, and then the sources of the funding sources, a bit separated, financial ratios, and then also the KPIs to understand what does our business plan mean in terms of how many users we are projecting, how many subscriptions we are projecting, and if we don't agree or so, if you want to change something, all you can do is go back to the assumptions and, for instance, here lower or change the growth a bit, make it maybe a bit less, in this case, a bit less aggressive. Okay, and then if you want to go back, you can see how those changes affect your assumptions. And then also a bit further below, you can see a calculation of the free cash flows. We first look at this from an unlevered basis, then later on we also look at it from a levered basis. And what we want to understand is how much funding is required. We also have here included the terminal value. At one point we will exit, at what is the supposed exit value, and how much money this business generate. In what we now should do is we should switch to the executive summary. On the executive summary, there are various charts which basically tell you the story about your business plan, also more in details about the monthly recurring revenues your business plan is assuming, the average revenue per user and month, and other financial ratios. And what we first should focus on are the project metrics. We want to make sure that this project makes money, so the IRR has to be positive or actually above the discount rate. And we also can simulate, if you want to use a different investment period, how this will affect the IRR. If you want to exit a bit earlier, what would this mean in terms of IRR? We can also change the model of the exit valuation. We can either value the business based on EV/EBITDA, or we could also do EV per subscriber, and you can simply enter the respective multiples. The next topic we want to look at is the break-even point. Here we have to select which year we are focusing on, because depending on the year have a different cost structure and have different fixed costs. So let's have a look here which year is of interest to us. Let's say we want to focus on year 4. So we need to know at which point the number of users and subscribers will be enough to reach break-even. So that year, that will be 2024. We assume that cost structure of 3.6, and then you will see you'll require 35,000 subscribers to reach break even. The wall calculation is visible in this separate sheet here. What we also want to understand is the customer lifetime value. For this, we have a separate sheet to calculate this. And the question is, how much value can we get if we secure one subscriber? And the way this sheet works is that we look at on an average basis, one subscriber would purchase these percentages of subscriptions. So we split his one subscription into these parts. And as you can see, we have here this churn rate assumptions. So this means monthly subscriptions means that at the end of the subscription period, only 50% will be renewed, and then 50%, etc., etc. And if we look at the longer periods, you see that this effect only plays a role after 3 months, then for 6 months, after 6 months. So this means the longer subscriptions are safer, and also the risk that he does not renew is a bit mitigated. And what we do is then we add up on a proportional basis to see what's the expected revenue after 1 month, in month 2, etc., etc. We add this all up and we plot this basically all the way forward over the customer lifetime period. And then we figure out the customer lifetime from subscription, it would be that amount. And then what we do is we add this up in case we have affiliate income, advertising income. We also do that. In this case, we don't discount it. We just keep it in absolute figures, because it's just to make things easy. We don't want to complicate things. If we go back on the executive summary sheet, important is this chart. That's how much value we want to get. And you see in the first year, this subscription has a lot of value. This also means we can get a lot of our money back in the first year. What we then also need to be aware of, at the moment we only look at the revenues, and then here we also have all the OPEX and all the direct costs. So what we do is we look at this EBITDA margin, and we need to take one EBITDA margin from a normalized year. So in this case, we have 2025. We could also say a normalized year would be a bit later. Let's say 29%. So this means from this $200 on average, 29% are resulting in lifetime EBITDA. So that's how much profit we can get. Then another aspect to that question is how much can we afford to pay to acquire one customer? As mentioned before, we have 3 channels of where new subscribers can come from. This is from organic, referrals, or paid traffic. And what we do is we basically compare the acquisition costs. So for paid traffic, we have the cost per click, we have the conversion rate, we can calculate how much on average it costs to basically get one subscriber via paid traffic. So you see this $10. This $10 varies because we are assume here a slight efficiency improvement in our ad campaign. As we are going forward, we expect some learning effects. Then affiliates, we also look at how much paid commissions we have to spend for affiliates, how many subscribers we can get, and we can calculate how much it costs. So surprisingly here, affiliate program is quite expensive, but of course subject to the assumptions. And then for organic traffic, what we do is we just take the general marketing budget and divide by the number of organic subscribers we can get. So it's just an estimate, but it should help you in triangulating and to figure out how much you can afford to pay. And what you want to do is you want to make sure that these costs are lower than your customer lifetime profit so that you make a profit going forward. Next topic we want to look at is the whole uses and sources of funding situation. So the starting point is the calculated required equity amount. What this model does is it gives you a figure which might not be rounded. So if you prefer to work with rounded figures, what you can do is you just set this to the rounded amount you want to inject, and then all the rest you add it as a reserve, or I call it equity funding buffer. So we round this up here. Just do it this way to add it, and then we have rounded it up to in this case 900k. The model has also debt schedules included. It's just to make the point that you could also use debt financing in case you have that option. Then what the model also does is it basically checks until which year the funding should last. This is in this case year 3, and until year 3 this is the calculated breakdown of the funding amounts. And you see here one figure is negative. This means this comes from since we're talking about 3 years, we also produce some cash flows or some profit. So part of that profit can be used to fund these costs. That's why it's done like this. But it's just a suggestion. You can also override this schedule if you like to, or if you like to present it in a different breakdown. Then the next topic we want to look at is the shareholder situation. So in this case, we have 900k to finance. The question is, what's the desired equity structure? So you can simply enter the equity ownership these investor categories should obtain. And you can also enter who has to put up how much of the funding amount. This will calculate the required equity injection per investor. And then what the model does is it runs through each investor category to find out what's his specific expected profits, returns. And you can see is in this case, since founders and employees don't have to put up any investments, their IRRs are basically unlimited. but the IRRs for these investors, they're lower than the project IRR because they have to give away, they have to provide some of the cash funding which otherwise would have been assumed by these categories of investors. Then we also want to look at the pre and post money valuation. So we need to inject 900K. For this, we get all these investors, they get together a 45% stake. So this means if we look at the valuation of 100%, this is post money 1.8 million. This means pre money, we would talk about a 900K valuation. This also is a figure you might need if you talk to investors. What we are also interested to understand is which of our assumptions have the biggest impact on the, in this case, the IRR of the model. What we have here is a whole sheet of breakdowns and further tables. Among them, there is, depending on model version, is a sensitivity table included. In order to update this requires a lot of calculation power, so we have to go here to these settings and put this that this is automatically calculated. And then you will see that you have to wait a bit and the computer is running through to update all these tables by running sensitivity analysis and simulating what happens if, for instance, the user growth is 10 or 20% higher or also lower than we anticipated in the base case. And we basically run this sensitivity analysis for quite a number of assumptions, and we see what's the expected, what's the resulting output on the IRR. The result of this is this table. It's called tornado diagram. And we can see in this case, you see the assumed user growth has the biggest impact on our IRR result, then followed by the conversion, the pricing. So if we get a higher price for our subscriptions, that would be a good way to basically make our model more feasible, the holding period, etc., etc. So what you can do is you can use this analysis as a starting point when you want to go back and fine-tune your assumptions, or also run scenarios is a good starting point. Then once you're done, please remove this setting again to avoid that your model blocks. So update everything except for these data tables, so that your model is not being blocked. So more or less, I think that gives you a good impression what this model can do, and I hope it's useful for your next startup venture in the SaaS industry. I hope this walkthrough was useful. If yes, please give it a thumbs up. Don't forget to subscribe to this channel and visit our website efinancialmodels.com. A link to the model is included in the description below. Thank you for watching.